Is our economy move in a straight line, which means our economy is constant? No, the economy moves into cycles, which means the economy improves and then deteriorates. We have an expansion and then we have a recession. So here, for example, we have an expansion and then we have a recession. Then we have a boom and then we have a burst and so on. Therefore, we could have two types of economies. The first one is like this. We have a smooth fluctuation in our economy, in our GDP, and then the other one is like this. So which one would be better? The second one is better than the first one. And that's why the rule of any country is to reduce the volatility of our economy, to reduce the fluctuation in our gross domestic product, in our GDP. Consequently, for any country to stabilize our economy, they have two policies. They have monetary policy and they have fiscal policy. I would like to focus now on the monetary policy. So, who is responsible for the monetary policy? Central banks are responsible for monetary policy. In Australia, it's called RBA, Reserve Bank of Australia. In the United States, it's called the Fed, the Federal Reserve. So, what are the tools of monetary policy? How any central bank can stabilize the economy using monetary policy? So, two tools. From its name, monetary policy comes from money. Therefore, the first one is money supply, the amount of money in the economy. Second one is interest rate. And usually, these two variables are interdependent. For example, let's assume that we have a recession, like what we are currently experiencing in 2020, the coronavirus pandemic. The majority of countries started to go into lockdown, which results in lower GDP, lower productivity, and growth rate will be low or negative. So, in order to get out of the recession means that we have high unemployment, many people lost their jobs, we don't have enough liquidity in the economy, people don't have enough money to purchase. Consequently, for the central bank, they will increase money supply. So they will try to increase the liquidity in the economy. Consequently, if we have a surplus of money, the interest rate will be lower. Lower interest rate will encourage people to consume rather than to save, because this means that in the future they will get a very low return, because interest rate in the majority of countries to be very low, and some countries became zero, such as United States, it's nearly 0%. Some European countries, 0%. Japan, 0%. Australia, the cash rate is 0.25%, a historic low. And at the same time, it will stimulate investment. For investors, they will have a motive now to borrow in order to invest. Why? Because the cost of debt and the cost of borrowing is very low. Consequently, what is the major objectives of any monetary policy? Two major objectives. Number one is stabilize the economy, which means we want to avoid depression or a bubble. Second one is we need to have something called inflation targeting. What do I mean by inflation targeting? We don't want a continuous or a sustainable increase in price to be very high, 20%, 30%. So what do I mean by inflation targeting? We would like to keep our inflation rate for 2 to 3%. And you discover that the majority of developed countries, they have or they succeeded in inflation targeting, which is maintaining the inflation rate between 2 and 3%.